out of the gate thought that people would have been curious about Netflix and Google. The fact that nobody asked about that just tells me that they're both probably going higher, just so you know. It seems like it's an underinvested in situation there. Anyhow, let's rock and roll. First and foremost, let's get through the data du jour. We had a situation today with the Beige Book, which came out really not all that eventful. But I'll tell you this: my take on that is this thusfold. I'll go into that a little bit here. I took some notes on the Beige Book. What my big takeaway was, though, was they talked about modest to moderate growth. There was no real wage pressure, and they describe inflation as mild. They also talked about the strong dollar holding back manufacturing, and that sector got a downgrade from the last Beige Book reading, to my estimation. They talked about economic activity being modest, continues to expand modestly, retail kind of expanding modestly. Labor market, they said, is tightening a little, but there really is no major wage pressure. They talked about some low inventories, consumer and business loans modestly expanding, stabilizing energy. Yeah, I mean, really very lukewarm, tepid here. Again, for the Fed to want to raise interest rates, they need to see, in my view, an economy that is booming, right? They need to see wage growth, pressure on wages. They need to see, I'm just looking up the Fed, the probability of rate hike. They need to see inflation, really, and they need to, which would come through wage pressure, and they would need to see a hot economy, and we know GDP has been rather wanting. So the summer's over. We don't have the carnival ride operator jobs to fall back on for employment number beats. And I guess we're going to have to rely on Salvation Armies and mall Santas to toe the line here. So, that's a shot there. I've been talking about adding in some drinking games here to the game, and I guess the keywords today are going to be Mean Red, which is of course referred to as Loretta Mester. Anytime I mention anything about carnival ride operators or now shopping mall Santas, you can do a shot. So, the big gag is going to be the twofer here, that we're now going to incorporate drinking games into Periscope, and also we're going to start cutting the length of the weekend review videos. They've been usually close to 45 minutes to an hour. I'm going to try to keep them more like close to 30 minutes to maybe 45 max. So anyway, let's dive right into this. We had a look below and fail. Let's just do it, right? I mean, why mess around? Let's go into this here. The Fed minutes were, like I said, not really all that. Not Fed minutes. The Beige Book wasn't all that eventful. The market stalled today right at a very key technical level, which I don't know if many people noticed, but I will detail it. With regard to SPY, we stopped right on the downtrend line and pulled back. The interesting part, and I was kind of looking to see how we closed today, I guess the must-go-home flat crowd came into the picture late in the day, which they have the last few days, and they kind of sold the market, so we had a bit of an inconclusive close. The prior day high of day was 214.31, and today we closed at 214.28. So we closed still within inside of yesterday's range. However, were able to manage to recapture the 100 and the 10-day MA, which is good. So that I'm pleased to see. If you also noticed, and you all know if you've been following me for a while, I can be very, very nuanced when it comes to my SPY levels. They're sort of very hypersensitive and very hyper-accurate. And today's low of day tick was 1 penny above the look below and fail high of day, which was 10.13. That was the day we looked below the range and failed and closed back up above it. Anything, in my view, above that 213.59 still kind of keeps the dream alive to the upside. Back below gets iffy. So I'm going to keep it really, really simple. We have now a key point we're making. We're making some higher lows on this leg. We have not yet made higher highs. I do think if we could get above the 214.70 in SPY, that it would trigger some algorithmic trading and potentially stop losses. We're not there yet. We're getting very narrow here in the end of the triangle. So I do think we are going to resolve soon, either up or down. What surprises me is just how pessimistic people are. I've done some polling and just feeling around in the crowd. It seems like people are very, we're only a couple of % away from all-time highs, and people seem rather bearish to me. So it seems rare to me that retail traders are all short up at the top and then get rewarded. Usually it's the kind of, the options get worn out, or there's a move down, they all get short, there's a move back up, they get stopped out, and then there's the follow-through lower. So just keep that in mind. If you're trying to play for a move either way, you might want to consider longer dated options. I'll keep it real simple like this. Anything above the 100 MA, I think you could use today's range really as a good gauge. Above the high of day is probably a good long. Below the low of day is probably a good right or right out short. In SPY, that's 214.64. Like I said, 214.70 would be over that last high, and we'd start now making some higher lows with some higher highs. Below the 213.60, and if we could get back into that look below and fail day range, it then becomes just a choppy mess, and then probably favors a little bit more bearish. I'm thinking if we can continue to hold the 100 MA, we could retest the 50 MA. Anything that starts closing back below the 100 MA, though, I'm going to start having to think again that the 200 might be in play. So that's my nuanced take on SPY. With regard to the Fed, we all know that the Fed has been discussing interest rate hikes. I think that's been what's been holding down the tape a little bit. As of right now, the November meeting is really nothing to be concerned about. It's only a 7.2% probability of a rate hike. That is just never happening right in front of the election. Fed might say they're not political, but they are not stupid. So that, in my view, is just not going to happen. What I do think is going to happen, and I feel a little remiss that I didn't mention this in my last week's Periscope, is I think that the Fed will signal, if there is to be a rate hike, I think they will be a little more explicit than they have been in the past in the November meeting minutes. So they're not going to necessarily say we're hiking next meeting, but they might say, the risks are to the upside, with the economy. They'll move their economic projection forward. I always say it's like porn. I'll know it when I see it, and I will report back to you guys if I believe that they have shifted still further. In the last minutes, they moved from not even from dovish to neutral. They moved halfway, in my view, from dovish to halfway between dovish and neutral. So they haven't fully flipped the switch, kind of over the top-ish, but they are kind of moving a little bit more in that direction. You have a very big breakdown in the Fed. You have Rosengrantz, mean red Mester, and Esther George, who are in the hawk side, and the rest have been in the dove side. As tough talk as Stan Fisher has been, he has not dissented. And he talked about an economy with potentially stagnant growth. And you had Yellen, who came out right after, who mentioned, maybe running a hot economy. They have mentioned, I've mentioned before, and this is this is sort of my foreplay to get into talking about the bonds. You had the kind of what I refer to as Yellen's come to Jesus moment, when she kind of reversed course after the initial rate hike, which we know I said was the wrong side of policy, which they did last December. And I've said that the risk, the time for potential risk with another rate hike would be again in December, which we are fastly approaching. The come to Jesus moment was the 12th, 4-12, and after that the market kind of rallied and then just kind of chopped back into range, ultimately resolving higher, only to come back on Brexit, and now we're significantly higher. So Yeah. Anyway, with regard to the TLT, that's kind of what I've been hinting at. We're right on a kind of trend line here. We've been in a channel for a while. It's kind of just hugging around here the 200 MA. If this were to fail and we come down, I see the risk down to like the 127s, maybe 126s, 125.86 is the 61.8. So this 200 MA here that we're kind of trying to resolve is very key. Today we had the kind of a breakdown, a bit of a look below and fail on the 14th, and now we're just within side of that day's range. The high of day that day was 132.95. Today's close was still 132.32, and we had a bit of a look above and fail on the 200 MA. I'll keep it this simple. The bonds, the risk to the downside in the TLT is we've now spent 1, 2, 3, 4 days below the 200 MA. If we get back above that, I think we will rally back to 135s. But anything that remains below there to me is still a little bit vulnerable to 129s and maybe even 125s, 126s. So that is my view. It's been reported in the news, by the way, that some foreign governments, particularly the Saudis, and I think China, have been selling some of their stakes in treasuries. It doesn't seem like an opportune time for the Fed to want to raise interest rates if there's selling pressure from foreign governments in our treasury market. Maybe they're trying to front run the Fed a little bit. But my view, by the way, if there is a rate hike, and I'm still in the camp that December is on the table, given everything that the economic data, given everything the Fed has said, they should not be hiking in December. What they should do and what they will do are two separate things. I think that there is still a very high probability of the potential for a rate hike. It's far from a done deal. I've said this for a while, but the Fed really should be very careful of this. They have not met their obligations with that, and the pullback in bonds has been rather gentle. I would like to see some type of a panic move in the bonds ahead of the Fed meeting to kind of buy the dip, believe it or not. Because the last time the Fed raised rates, that was sort of the bottom in bonds, and they did nothing but rally. I think the Fed has been very methodical in the fact that they have their agents come out and mention all kinds of they play games with the markets. One of them talks dovish, one of them talks hawkish. I mean, I'll tell you, you have the 12 districts reporting. It sounds very may the odds ever be in your favor to me, very Hunger Games-ish. This type of financial fiction. The economy is not doing well. They have no business raising. And I think the last time when they did do the hike, the market sniffed out that there would be economic weakness as a result, and that bottomed rates and they rallied. So here's my view. If they rally the bonds into the Fed, there'll probably be a sell-off. If they dump the bonds in head of the Fed, there'll probably be a rally. So this is going to be a Costanza type of play. Could use do a shot with that too, maybe a small one. Anyway, that's my view on the bonds. Oil is a key. Fed did also mention that they're seeing oil stabilizing. No shit, Sherlock. It has been stabilizing, but maybe for the wrong reasons. Oil has been stabilizing because there's a threat to the supply chain. The Saudis have hinted that in the November meeting that they are going to lead a production cut. That gave the green light to oil, and we have now broken out. Today was actually a breakout in oil. I want to see where it closed, though. I didn't see the exact closing. Yeah, we did close strong over the last high. So we are into some remarkable resistance here that I have noted. If I'm just looking pure technicals, you had a channel break officially on 10.3, and now it is resolving to the upside off of an inverse head and shoulders bottom. So this, if we want to get really, really technical, I don't have my calculator. I'm just going to have to do it from eyeballing it here. We would be looking at about an $8 resolution. No, what was the high there? 49.36, and the low here was 39.26. Wait, what was that high? So a $9 move, so off of 48. 7, would that be? Yeah, actually, that would roughly be the gap fill to 56.5. So I'm just, is that right? Wait, these charts. Sorry, they're still giving me issues with this update with the chart. My charts have just never been the same since this last toss update. When was the Ledgery? This was back in, sorry, that was in 7.2 in 2015. That was really where the big gap and break came from. So oil looks like it's pushing up. If it were to do it tomorrow, it's clearly not. The high of the range is 62.58, and that is the high of the channel here. Anything, in my view, we have back over the 200 MA firmly here. To me, it looks like the bulls are in charge with regard to oil. I don't know that you need to chase it here. I do expect there to be some resistance. This 49 to 51, 52 area was key. The next big resistance comes in around 54.24 to 56.5. So I do think that there could be some back and fill here, but I like row buys off the 50, 100 MA confluence area. This is obviously great for oil stocks. I've been long this Enbridge for a little bit. I'm long a little bit of BP. I think Chevron in some account. I have to look, although I don't know. I bounce between these accounts. I sometimes forget what I even have on. And Exxon has been my favorite one. I've been looking for a pullback in Exxon. I had sold like high, roughly around a little bit ahead of the channel high. It turned out to be the top, and I wound up buying it back basically at the low. I can't say that it's just because I'm good. I got a little bit lucky with some of those entries, although that wasn't fully luck. The bad luck is I wanted to sell more puts. As I talked about this, and I detailed how I was looking to build more of a position. And I wound up selling some puts when it was below 83 in Exxon. I was looking really to be full around 81. It never got the full final thrust, and it came back up. So I guess it's a problem because I don't have a full position on, but I'd rather be in the trade than not. That's often why I feel for the bottom sometimes. I talked about not necessarily adding to losers, but when it's calculated and you're starting out with smaller size and you're feeling for the bottom, this is exactly why, because of a situation like this. I'm not so upset because I at least have a decent chunk of the trade on. It's not a full trade, but it's a good amount. So I like buying the dips in oil here, given the fact that we're punching out here. Like I said, there could be a little bit of a look above and fail and a come back down, but I'd like it on buys on the 50, 100 MA. That's roughly right now in the 40, where is this? It's still almost 47s. I don't know if we're going to get that large of a pullback here, but as that comes up, there'll be an opportunity. I'll tell you from experience, when you sell puts, you want it to be on down days. Don't do it into up days. I can't even tell you over the years how many times I've gotten myself into trouble because I've done that. It's worked out really well a lot of times, but any times I've had problems with put sales, it's usually because I don't have the best trade location, and then I have to kind of spin the plates to make the trades kind of okay. Wait for a pullback. We're in a crazy market. There will be some kind of a headline that takes it down. So that's oil. Let me see. I'm just going to plow through some of this stuff that people have been asking about. People were asking me about Mexico. I don't really follow the Mexican market all that much, I have to say, although we are looking a little bit inverse head and shoulder-ish here, believe it or not. Yeah, we are, actually. I'm glad this was pointed out. Once in a while I get, I give a lot of trade ideas out, but once in a while I get some good ones. I like this long versus the 200 MA. That 200 MA was really where the breakdown took place from. It's looked above many times, so as long as this holds the 200 MA, I'm okay with being long. Back below, I'm not as keen on it. And you really, you have a couple of necklines here that you could use. I would use the lower one here, which would be 54.69. If you can clear that 50, let me see, what was this? You had two highs here. 54 quarter. Yeah, if you can clear the mid 54s, this thing should be able to move. I'm interested in buying some pullbacks here. My guess is that this is a political play here. Maybe people think that as Mrs. Clinton's polls are rising, that maybe this is going to bottom or what have you. We'll see, but I like some pullbacks in that. Taser, I mentioned the other day. That we were getting to a key level. I talked about 21.39. We got 21.5. Basically, we held the 50% fib. That is actually an island reversal, morning star type of reversal play. I'm okay with. I had said that was the area between that area and 1990 to start selling the puts. Turned out to be okay. My big concern with Taser is the contracts. That they had a competitor come in who basically outbid them in New York. Their average monthly price is $40 a unit, and this competitor came out at $20. Not a profitable position. I know they did this to undercut just to get the contract, but the fear, and I think it's more of a fear than a reality, is the fear that other municipalities will say, okay, we're going to use this now as the baseline for our negotiation. So the street doesn't know. Let's keep it simple. Today, the last couple days, we've basically been trading around the 10-day moving average. If you're above the 10-day, I'm fine being long. It basically bottomed on the 200. So in that range, I'm okay being long. If it starts breaking down again, it's kind of a no-go to me. I'd be looking for a bounce back, though, roughly to the 25s. I think that would be a reasonable upside target. Twitter. All right, so here's the deal with Twitter. If Twitter was smart, and listen, I'm a huge fan of the platform. It's actually that and Instagram are like my favorite social media. My big beef with Twitter is that they're not growing their user base fast enough, and now they're basically out of the game for an M&A deal. I don't know if that's necessarily true, but that's the street's kind of judgment. There's a lot of open interest in November in the 11 and 12 puts. So I think people are just kind of making the assumption that if it can't go higher, it's going to have to go lower here. It got a bit of an upgrade today. We're still below the 200 MA. I think this is just going to chop around for a while. Yeah, I mean, if you want to pick a little at Twitter, I'll tell you, the streak came around on Facebook when it had two back-to-back solid quarters. Twitter can't even do a quarter that has been solid. I think they've had one, and it actually wound up being one that I was bullish on. But since then, it's just been, choppy. And I think that there's been an inherent put in that they would be bought. That put seems to be removed. I don't necessarily know that that's the case. I mean, if you were negotiating, would you come out and say you're buying something? The price would obviously go higher. So it seems to me that if this gets much lower, that M&A speculation might start up again. But why would you buy Twitter? They're not a growth property. If you're buying social media, you want to buy growth. I think that this would be a fantastic play for, the data from Twitter isn't even as high quality as it is from Facebook. So that's just my view. They need to return to growth, and they need to update their platform. It's been about a little over a year since Dorsey came back. I've said for a while they need to make the platform more like Instagram or Snapchat. I don't think it should be an exact copy, but you're not going to get younger people to use the platform. Most people I know don't even know how to use Twitter. As crazy as that sounds, I'll tell you, I didn't even know how to use Twitter for a very long time. Most of the time I kind of just used it and didn't, only until I got into really using it as part of the trading community is when I got into Twitter. If you don't have a lot of followers, if you're not following people, it's just not as intuitive. So I think they need to make the platform a little bit more, they need to do more with it. It needs to be, I don't want to say dumbed down, but they need to expand the appeal. How's that? They need to expand the appeal, and they need to grow the user base. If they, user-friendly, correctly, if they were smart, and they're not, they have not been smart, they would, number one, verify my account. That would be very nice. Number two, they would they would do it. I mean, the presidential debates, everybody is talking about the presidential debates here. Why isn't Twitter hosting their own presidential debate? They should come out and say, Mr. Trump, Secretary Clinton, why don't we do a fourth debate hosted live on Twitter? That would be huge, but they're not doing it, and they're just, I don't even want to talk about it anymore. They have missed so many opportunities here. It's just an embarrassment. I mean, I think you could go down to the bodega and make someone CEO who would probably have some better ideas with regard to this property. I'm sure there's more going behind the scenes than we're aware of, but they are not executing. You know, they talked about reducing, and I don't want to spend too much more time on this, but obviously you can see it's a topic that upsets me. They talked 2 or 3 earnings reports ago. They talked about reducing the character count, impact from posting links and posting hashtags and stuff. Why isn't that done yet? I mean, how long does it take to do this? I mean, maybe they're going to do just some big overhaul, but they have not done it. And the platform, they need to start showing the street that they're getting their act together, and they really have not. It's just an embarrassment. Jumping back a minute, I'm sorry, I didn't mean to cut this off, because this is really the key. The dollar. I mentioned that I was talking about the bonds. There is an unholy troika that you could add that to the list of whatever, of things that the market is keying off of, algorithmic trading. There are 3 things it's keying off of. Could either do the American 3 or the German 3, whichever you guys want to go by. But it's oil, bonds, and the dollar. And any given day, one of those can take over and be the driver of the market. But when you have all 3 of them going in the wrong direction, meaning yields going up, bonds going down, dollar going up, and oil going down, that is a no-no. Those are the days that the market just can't get out of its own way. It's sort of like the end of a senior prom where everyone just is puking all over themselves. Days that the market has been able to find some legs are the days that the dollar goes down. I've said for a very long time, the biggest risk that this market faces is a strong dollar. It's going to hurt companies' earnings. And I'll tell you, they're just killing it right now, but I'll tell you, the last time the dollar was up high was when Facebook earnings started running into some trouble. So if they gun this thing into earnings, it's probably a good idea to take a little bit off. I think Facebook longer term could go much higher, but I'm a little tentative if the dollar keeps going. The dollar now is making higher lows and higher highs. It seems like it wants to go back and test 100. The upper channel resistance, if it were to, is like close to up there. Yeah, I mean, the dollar could pull back. It's probably run a lot. It's due for some consolidation and maybe some pullback. But unfortunately, into the Fed, this is probably going higher. I've mentioned before, and I know this is going to be very confusing, but I assure you this is the logic. The higher the dollar goes, the more traders are going to think the Fed is going to hike, because the dollar is going higher, which hikes would be bullish for the dollar. But as the dollar goes higher, the Fed is going to be conscious of that. They already have a problem in manufacturing, and they don't want the dollar to go higher. Their stance right now, just being neutral, is more hawkish than any other central bank. I should say major central bank, ECB, BOJ, etc. So their hiking would exacerbate the rise in the dollar. So if the dollar gets real jiggy into the next meeting, we could have a major opportunity here for the Fed maybe blinking and not going. So keep an eye on that dollar. But as long as this thing holds over the last swing out, the last breakout of the 97.62s, this thing just looks now like it's bull flagging the last few days. The major moving averages are much far below. They're in the 200 is down in the 95s, the 50 and the 100 are down there also. So, maybe we do get a little bit of a pullback in this or some consolidation as those averages catch up, but dollar is looking pretty bullish. That has wreaked havoc in the precious metals department. Gold and silver are just getting their face kicked in. this was also really heavily chased. I mean, this thing was up, GLD was up 30% in, from the low in December to the high in this looks like July. Yeah, July. And now we're pulling back. We're not even back to a half back. If you go, depending on which leg you go into. I'll keep this real simple. 200 MA plus, it could continue rallying. We had a bit of a gap and hold above there today. I think that this just got a little ahead of its skis. But I'd be really more interested in this somewhere between the a retest in the 115s or even the 112s. That would be the 61.8 of the entire range. Gold loves 61.8% fib retracements. I'd be an interested put seller, out of the money put seller there. But the 50 and the 100 MA are roughly around 125. That's also around the gap fill. I'd be interested in right or right out short if we were able to get that gap fill. So I think the issue with gold is the dollar. That's it. Until you start breaking the fever in the dollar, meaning making lower highs and lower lows, I would stay away from the precious metals and be looking more to short the rallies than buy the dips. Silver is coming in. I'm interested in buying this thing roughly at the real breakout. Also 61.8 was 15.59 if we can get down there. It held the 200 MA. The bounce has been rather meek, but holding. It was a slightly higher low. But yeah, down there I'd be interested in selling out of the money puts. I had bought silver a while back at around 14. It was a little early. It got down to 13, but then wound up pumping it out around 17s plus. So that wound up being a pretty big home run. I like silver lower. Yeah, somewhere between, like I said, the 15.59 and $15 in the 15 range. I'm interested in selling at the money or out of the money puts as a long proxy to start growing into a position. Let's talk about some of the Momo du jour, Netflix. So this wound up being, I said that I thought we would, the 50 MA was a row play. Wow, it's pretty strong. This thing gapped and went. It was a 2 times the expected move type of play. It was only expecting about a $10 move. It's up about 20. This looks like it wants to get back up to like the 129, 130-ish level. I don't know if it's going to be a straight line, but I usually like to use the earnings gap day as that range as a guide. Anything above 1982 is bullish. Anything below 16.5 is a little bit more iffy, and I would think that would probably fill down to somewhere between 110s, or I should say 112s and 108s. Maybe 105s at the, or 106.96. Probably somewhere between the 108 and 106, maybe at the worst. I don't know if it would. I don't think it would really get down there. I think there are a lot of people here. Someone said that the sound just died. If you're, by the way, watching this and you're having sound issues, I saw a few people complaining. The rebroadcast of this will be on my YouTube channel shortly. After the broadcast, I'll hook up the phone to the computer and do the download and upload it. Anyway, that's my thought on Netflix. I had someone ask me today about shorting Netflix. They were citing valuation issues. That's not the right way to look at this. This is pure technicals here and the path of least resistance. I'll tell you, once a company reports in a quarter this late kind of in the year, they become safe havens if the numbers are good. If they're bad, they continue lower, and if they're good, they continue higher. Like Netflix, The Gap, these are stocks that are now proxies. Like if you want Momo, you know Netflix's quarter is out of the way and it was good. So it's safe to be the BTD, buy the dip. The same with Gap. The retail numbers are out. That most of them have been horrendous. They do report earnings soon, but their comps were out. They weren't that great, and the stock rallied. So I think that once you've had information that's out on companies that report and the numbers are okay, they go. I will caution on a couple of things with regard to the momentum. I've seen this before where you have the first few Momo stocks report, they're good. All of them rally, and then the back half of them, they all, the ones that report that had rallied on the initial ones, get slammed. So just keep that in mind. Look to be buying the dips in the ones that report that are good, and then selling the rallies on the ones that report that aren't good. I'm pretty sure that that's going to be the theme for this quarter. Google is looking kind of bullish. It's all-time highs. All-time is a long time. I talked about this breaking out. I talked about this seeing channel high. I talked about this seeing 895.44. I still think so. I like buying the dip in this ahead of the. I think that the trade, unfortunately, here will be to play the run-up into the earnings. So if this continues to run into earnings, it'll be an opportunity to book profits. If it pulls back ahead of the number, then it will be an opportunity to load up for I think a long trade for the earnings. So I'll keep it that simple. I'm just looking at some of the other stocks people want to talk about. Caterpillar, someone asked about. It's been doing the slow creep. They are reporting soon. This thing is up from 56 now to almost to 90. And it's into some reference resistance here. I would be booking some profits and looking to buy the dip if this thing could get back to the 200 MA. Longer term, this has some room to the downtrend, which is up at 106s. It could get there, but I can't say buy Caterpillar here after a move like this. I think the risk reward is a little troublesome. I talked about Deere. Being long Deere after the number, buying it around the 61.8. It turned out to be correct. It actually eclipsed the last high, and now it's kind of pulling back a bit. So, yeah, I mean, I'd rather be in Deere now that we know they reported a good quarter. I'd rather buy dips in Deere if you're interested in that type of a situation. Also, the Fed, by the way, in Beige Book talked about weak commodity prices, but it was sort of a mixed bag in agriculture. It seemed, in my view, that would be more Deere-friendly. Smith & Wesson pulled back to almost to the trend. It didn't quite get there. It's now rallying back up a bit. I think the fear here is the gun control, right? If Hillary is elected, she might issue executive orders, and we might have a gun control fiasco on our hands. As long as this thing holds trend, I think it's kind of okay. Shorter term, you could use the 200 MA. That's been the support. So 200 MA, I'm okay with being long. Below, it gets a little more iffy. It is still. Did it break the downtrend? Let me see here. This, by the way, is Smith & Wesson SWHC, not one I talk about that often. I want to just see. Hold on. Did we break the downtrend? Yeah, a little bit. We broke the downtrend. They haven't reported yet. So I'd be all right with this as long as it holds the 200 MA on pullbacks. Yeah, it could easily rally back up to the 50 and the 100 MA, which are above. The caution I have, though, is that the 50 is downward sloping. I'm just going to keep it simple. 200 MA plus, I like long. Below, it's a GTFO, meaning get the F out. That's plain English. I talked about this Twilio and Acacia. I said the easy money was made. I talked about bounce plays in this. And then I said to just disavow. Twilio, the breakout was 44.80. Anything above there, you have tweezers with look below and fail at 44s. 44.31 and 44. What the frick was this? 44.31 and 44.41. Could use that swing low, in my view, as a right or right out situation. If it breaks, you're not going to want to be involved with that situation. I don't like my fib drawing here. Wasn't great. Fibonacci retracement. Let me just draw that in again. For some reason, that had not been at the proper low. 23. Yeah, the 61.8 was. It would have been 41.73. There's another swing low at around 37.20. If this continues to dump, which would be the ideal scenario considering it's come down so far so fast, into the 61.8, which is 41.73 and 37.20, I'd be willing to entertain selling near dated out of the money puts as a long proxy, because this thing has just gotten so far so fast deep. This was secondaries coming on. I don't like these stocks after you've had you had the initial double the range to the 65s. It overshot a little bit, but I think the easy money in this has been made. You had a lot of chasers. That I can't even tell you how many people have been asking me about this stock. Not a big fan. Acacia, I'd be interested in buying the gap fill and the 61.8. There's a confluence around 67.70 and 65.89. I think a move into there, you could probably buy the dip for a right or right out, or the same thing, a near dated out of the money put sale. That's it. I think we're going to call it a day here. We've covered a good amount of stuff. So if you missed the broadcast or want to catch more of it, it's going to be reposted now on my YouTube channel. That's Justin Pulitzer Trades. If you're not following me on Twitter, my handle is @JustinPulitzer. That's where all the magic happens. Anyhow, that's my story. I'm sticking to it. There'll be a weekend review video on Sunday as usual in a more abbreviated format. So let's have a great rest of our week, and cheers.